very good discussions on foreign currency translation. So you can just refer to the book for all this, though we already have the module. You have the meanings, and aside from that, the various rules in connection with the use of the exchange rate. So what's important, yesterday I already gave you the basic terms in connection with our translation, and you have these terms defined, and also the translation formula in determining the final amount, which should be stated in pesos, where you have the accounts in foreign currency units, and then we multiply by the appropriate exchange rate, and so you will have the account in Philippine peso. Now, there are so many important terms that you have to understand. These terms should be considered before you go on with the problems. Now, like for example, functional currency, which is the currency of the primary economic environment in which the entity operates. Then we have exchange difference resulting from translating a given number of units, one currency, into another currency at different exchange rates. We have the term foreign operation. The activities are based or conducted in a country or currency other than that of the reporting entity. We have the term closing rate, the spot exchange rate at the balance sheet date, spot rate, the exchange rate for immediate delivery, and presentation currency that is used to present the financial statements. Other than these terms, you can still have more terms. You refer to the book of Dayag for all of this. Dayag here has very good and complete discussions with regards to foreign currency translations. Now, of course, we have to understand the meaning of the current rate method and the temporal method. In the current rate method, the financial statements of the entity are prepared in its functional currency and translated into the presentation currency when it is different from functional currency. It means that the presentation currency is parent's presentation currency, the Philippine peso, but its functional currency is the local currency unit. Now, you have the discussions of this in connection with the current rate method. Method number two is called the translation into the functional currency. So one is translation into the presentation currency, or we call the current rate method. Method two is translation into the functional currency, which we call the temporal method or the remeasurement method. So functional currency, and we have the term known as the temporal method or the remeasurement method. Now, take note that we have this two methods to be used, and you have the discussions of this in our book. Okay, then also we have the choice of the functional currency, the applicable translation method. Now you can have a diagram on page 691. May I advise you to study the whole of chapter 8 for all these terms and as well as the guidelines in connection with our translation procedures. Now, of course, we have the translation from the functional to the presentation currency. That's translation into the presentation currency, which we call the current rate method. Now, how do we assign rates for under the current rate method? First, assets and liabilities, both monetary and non-monetary, are translated at the current or closing rate. So for your assets and liabilities, income and expense items of the foreign operation are translated at exchange rates at the dates of transactions. So we have now the actual or historical spot rates. Now, translation from functional to presentation currency method. So that's the first. Then, for practical reasons, the average rate is usually used for items whose transactions are numerous and occur evenly throughout the year. For example, sales, purchases, and operating expenses. Though initially your income and expenses items will be translated by historical rates. However, due to the difficulty in determining the historical rates, then the average rates will be used. Now, that is the most practical method to use, the average or the weighted average, especially if this income, the expenses, elements occurred evenly throughout the year. Like, for example, monthly, you have this. You purchase, you pay your operating expenses. The fact that these expenses and income elements occur evenly throughout the year. So we use the weighted average method and no longer the historical method. Translation gains or losses are taken to other comprehensive income until the investment is disposed of for the purpose of recording your uh, items which are considered to be your items to be translated. So we can say that all assets and liabilities are translated from the local currency into their posting currency using the current or the closing rate. Like for assets and liabilities, we refer to the spot rate on the balance sheet date. So assets and liabilities to be recorded using the current or the closing rate, specifically the spot rate on the balance sheet date. Now you have there the definition of your spot rate. Your expense, revenue and expense accounts, as mentioned earlier, they will be recorded by using the average rate, the average rate. And because it's difficult to use historical cost. So we use the average or the weighted average rate for revenue and expense accounts. Okay. Then, for paid-in capital accounts, like your paid-in capital, or you have your capital accounts like common stock, your APIC, how do you assign rates to this? The paid-in capital accounts are translated using the historical or actual rate. Historical or actual rate. But the date to which the historical or the actual rate pertains depends on whether the acquisition was accounted for as an acquisition. But anyway, let's just consider paid-in capital accounts should be recorded at their historical or actual rate. Now, how about for the components of retained earnings? Components of the retained earnings are translated as follows. For the beginning retained earnings balance is set equal to the ending balance of the prior period. So the retained earnings beginning of the present period should be stated at an amount equal to the ending balance of the last period. So meaning the ending balance of the previous year or anyway period. In this case, since in most cases, when you involve first year, meaning to say there is no beginning balance. So the balance that you have to consider is the balance as of the beginning of the period. That's if you already have some uh, retained earnings balances. However, for we are talking about acquisition. So the possibility that the acquisition is made only during the year, but the affiliated company or the acquired company already had its beginning retained earnings. So you take that as the beginning balance. Okay, so for the beginning retained earnings represent entirely the pre-acquisition retained earnings, which is translated using the historical or the actual rate. So the historical or the actual rate at the date of acquisition. However, if the beginning retained earnings are already a composite of pre-acquisition and post-acquisition retained earnings, it is not possible to translate the amount of only at a single rate, as the amount is already an accumulation of 2 or more years' earnings. In most cases, you have to use the translated figure from the previous year's financial statements. So in other words, if you already have your retained earnings being an accumulation of 2 or more years. So for the current year, your beginning retained earnings, you have to use the balance end of the previous year. The balance end of the previous year. Now, one item which is a composite of your shareholders' equity normally will have an effect on your retained earnings. We have dividends. Dividends are translated using the exchange rate in effect when the dividend was declared. So usually it's the historical or the actual rate dividends, which is used to be declared or sometimes declared and paid. So you have to use the historical or the actual rate. Okay. And the foreign currency translation reserve gain is the balancing amount in the balance sheet. Okay? So you have your foreign translation reserve gain. That becomes the balancing amount in the balance sheet. Your net income or loss, as it should be reflected in your retained earnings statement, is the amount which is already translated as carried from the income statement. So I'm talking about the net income or loss already translated in the income statement. So you have to carry that forward to your statement of you have your shareholders equity where you will have your retained earnings. Okay, so that's now your uh, valuation, or what are the rates that we are going to use for the purpose of translation. And we are talking of the rates when we use method number one. That's using the current rate method. So current rate method. Now, second is the use of the temporal method. Okay, using the functional currency, it's still in Philippine peso, the translation into the functional currency. And we are using the temporal or the remeasurement method. The temporal method or the remeasurement method is used to remeasure the accounts of a foreign entity when its books are maintained in a currency other than the functional currency. The objective of the remeasurement process is to produce the same results as if the transactions of the foreign entity had been recorded initially in its functional currency. So I'll repeat, the objective of the remeasurement process is to produce the same results as if the transactions of the foreign entity had been recorded initially in its functional currency. Now, let's go to the remeasurement process. So, of course, we have the measurement process in the case of the current rate method. That's the first method. Okay? The current rate method, I already mentioned about the measurement uh, rules or guidelines. Then we go to the guidelines for the remeasurement or the temporal method. The remeasurement or the temporal method. Now, let's take into account your assets and liabilities. Assets and liabilities which are classified as monetary. Monetary. These are expressed in the balance sheet at current values, are translated using the current or the closing rate. Okay? So for monetary assets and liabilities are expressed normally in the balance sheet at current values